In a recent interview this morning, Tom Lee came out with yet another very bullish take on the market. He thinks that the markets are going to see all-time highs this year in 2025, and he's also outlining the argument for the Fed to be cutting rates in the near term here. So we're going to be breaking down everything that Tom Lee said in a little bit more detail, again, than what was discussed in this interview here. And as well, we're also going to be talking about a lot of your favorite names: Palantir, HIMS, Sofi, Neo, and especially Palantir and HIMS ahead of their earnings this evening here. So guys, before we get into all of that information and play the Tom Lee clip, if you guys do enjoy the information and analysis that I provide for you guys in these videos here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every time these videos are posted live. But without further ado, let's roll the Tom Lee clip and break it all down.
Joe, I do think tariff fears can come back, but the stock market and I think the macro is in a better place today than it was on April 7th. One is I think that the tariff expectations, even if we don't know what they end up looking like, are really much better than what we saw on April 2nd. The second is that the markets that lead stocks, such as credit and the VIX and high yield, are in a much better place. High yield has recovered almost all the widening that happened since April 7th, and the VIX is uninverting the term structure, which basically means the market for volatility is calming down. And then I think when we look at 2026, I think there is stuff to have some confidence about because the economy is holding up better at the moment. And next year we can look forward to deregulation. I think the comparisons for earnings will be much better for next year. And then, of course, if we get some tariff policies that lead to exports, we have upside to earnings growth. So all in all, I think it makes sense that the markets have recovered to this point. But, the bar for recovering to all-time highs is, of course, higher. But I do think the risk-reward is actually still positive here.
Yeah, I was thinking that, too, that you're probably thankful and gratified that we're back to where we are, but it just seems like there's some backing and filling that's going to be happening before we break out to new all-time highs. Do you think with the tariff regime as it is, some of the comments made by President Trump over the weekend that why would, if these are temporary, why would anyone build a plant here? So that some of them might be permanent. I still think it's negotiating. I'm still not sure I take that at face value. But if it's a permanent regime of tariffs, you still think we get to new highs in 2025 or by 2026?
Yes, I think new highs are possible this year. I mean, one reason is, companies have proven themselves to manage through shocks, and I don't think investors give them enough credit. That happened with COVID. Companies survived. Companies survived a bullwhip effect on the economy. They survived a surge in inflation. They survived the Fed hiking at the fastest rate ever. So I think this tariff shock, while it is shocking, I think earnings will probably outperform expectations. I mean, that'd be one thing. And then I think the things that were leading us down, whether it's Tesla or the Mag 7 or Bitcoin, they've begun to recover. The Fed has been on hold, and they're saying they're waiting for tariffs. But what's interesting is the ECB has been cutting rates, even though there's tariffs, inflation hitting Europe, or soon to hit Europe. The reason is ECB's inflation measure, the HICP, excludes shelter. If the Fed excluded shelter from its core inflation calculation, it's lower than Europe now, and yet Fed funds is over 225 basis points tighter than Europe. So I can actually sympathize with the argument the Fed should be cutting now.
So there were a lot of high-level concepts discussed in this interview here, but they were just briefly touched on. And I want to make sure that you guys that are watching these videos here are actually understanding some of the things that are discussed in these interviews here, and not just hearing those specific buzzwords. So one of the first things that Tom Lee talks about are high-yield spreads. Now, we've talked about this in prior videos, but when you see high-yield spreads starting to move to the upside, like you can see in this chart here, what it's showing you is the difference between either investment grade or sometimes treasuries, the yield on those versus higher yield bonds. So more risky bonds here. So when you see the spread between high yield and investment grade widen like this, it's basically telling you that there's more default risk in high yield, and investors are a little bit more worried about the overall economic situation in the economy here. So when you see these spreads widen, just think investors are getting very cautious here. Now, obviously, when we were going into March and kind of the beginning of April here, when we were seeing those significant sell-offs in the market with all of the uncertainty that we were witnessing, obviously high yield spreads were going to move up. And now that we are seeing them move down, investors are having a little bit more confidence in this market as a whole. And again, are now starting to place their money back into some of those high yield fixed income securities there. Now, remember, the relationship between bond prices and bond yields are inverse. So when you see more demand coming in for these high yield bonds, those yields are going to come down and then shrink these spreads, which is exactly what we have been seeing recently. Now, the next thing that Tom Lee talks about here is something that gets a little bit more complex, but again, I think is very important to quickly know, because again, it is showing a little bit more investor confidence in the short term here, and it has to do with this VIX term structure chart. Now, again, we could talk all day long and make this super complex, but when you take a look at exactly, again, what contango and backwardation are, again, just the basic definition here, contango and backwardation are terms used to define the structure of the forward curve. When a market is in contango, the forward price of a futures contract is higher than the spot price. Conversely, when a market is in backwardation, which is what the VIX has been in over the last couple of weeks and months here, the forward prices of a futures contract is lower than the spot price. So what does that mean in the context of what we've seen in the market recently? It means that there's a lot more demand for a lot of these volatility products right now than there are later on in the future here. Now, when we see this curve flatten, which is exactly what we have seen recently, it means that things are starting to balance out and overall investor fear is starting to move to the downside. Very, very similar to what we are witnessing in high yield spreads. Now, the next thing Tom Lee touches on is obviously the big event that we have this week, and that is the FOMC meeting coming out on Wednesday. Now, when we come over and take a look at some of these projections here for the May FOMC meeting, again, the market is not expecting a rate cut this week, and I think it's very unlikely that we are to see a rate cut this week, just based on the overall tone of a lot of the FOMC members, specifically Jerome Powell over the last couple of weeks and months here, really focusing in on a lot of those headline and core inflation numbers versus the slowing of GDP or just growth in general, and also the risk to unemployment moving to the upside here. Now, what Tom Lee is talking about when he talks about the ECB cutting rates and basically leaving out shelter from those calculations, and that gives you a little bit of a different picture of what the inflation situation looks like right now. You can take a look at Supercore, you can take a look at Trueflation, which we've seen right here, which is aiming to track a lot of the real-time changes in prices that consumers are going to be witnessing. But just in general here, what we have seen over the last week, when we saw PCE come out, was a significant decrease. Again, that February reading was about 2.7%, and the March reading was 2.3%. Again, Tom Lee is trying to make the argument here for Fed rate cuts coming in the nearer future than what the market is expecting right now. I would disagree with that just because we already know what the tone of this Fed is. They are very, very worried about this new trade policy and the potential effects of what it is going to do to prices in the short term here, and they do not want to act too quickly. So even though we have seen PCE move to the downside in the last reading, the next time we get this new batch of inflation data, well, it's going to reflect a little bit more of this new trade policy. And again, if we do see PCE, CPI, PPI, all of the core and headline numbers moving to the downside, then I think it's very likely that the Fed does start cutting in June. But if not, they're definitely going to back off. So now that we have the big picture of the market kind of out of the way here, covering some of Tom Lee's most recent statements, let's talk a little bit about some of these individual names. We'll start with Palantir and HIMS and then move into NEO and SoFi here to wrap up this video here. Again, Palantir has just been an absolute monster for retail investors here. Again, it is reporting earnings after hours today. I will be posting a video later on this evening on Palantir and HIM's earnings. So again, if you guys aren't subscribed yet, make sure you guys hit that subscribe button, turn on notifications so you're notified every time these videos do end up getting posted live. But again, like I've said before, in a lot of these other videos, I do think at this point, it's very possible for the market as a whole to hold Palantir to a little bit of a higher standard now after it has made such significant basically valuation movements to the upside here over the last year and a half. When we take a look at some of the analyst expectations, we can see that this quarter analysts are expecting Palantir's revenue to grow by 35.9% year on year to $862 million. Again, it's relatively close to that $1 billion mark there. If it does end up significantly beating analyst expectations and delivers a $1 billion revenue quarter, obviously, I do think that Palantir would move significantly to the upside, but again, that is a little bit aggressive of an expectation there, improving from the 20.8% increase it recorded in the same quarter last year. Adjusted earnings are expected to come in at 13 cents per share here. So Palantir, again, hanging out right at all-time highs here, going into earnings. They are going to need to deliver some very, very strong numbers in order to break this all-time high and continue to the upside here. And then moving on to HIMS here, really nothing to write home about today. I mean, the stock at the current time that I'm recording this video is up about or down about 0.7% on the day here. Again, another one that reports earnings after hours and off of the news last week with that new significant partnership with Novo Nordisk, again, expanding kind of the suite and access to a lot of these GLP-1s and a lot of the other products that Novo Nordisk does offer can easily be a significant revenue generator for HIMS moving forward. It'll be very interesting to see the comments from HIMS management surrounding this partnership at today's meeting here, earnings report here. And again, just taking a look at some of the projected numbers, HIMS is scheduled to announce their Q1 earnings results on Monday, May 5th after the market closed. The consensus EPS estimate is 23 cents, up 360% year over year, and the consensus revenue estimate is about $538 million, up 93.5% year over year. This has been one that has shown significant subscriber growth, significant revenue growth over the last few years here. And again, that's one of the reasons why this one has been able to grow significantly in terms of its valuation and share price here. Now, as we talked about in yesterday's video, a little bit more than 50% of the time, HIMS does react negatively to its earnings reports. And what I want everybody to understand, and I said this before, I will say it again, is make sure that you have a longer term vision if you are trying to be an investor in the markets here. If you see really solid growth, really solid numbers from earnings, and the stock does not react positively, which is always likely to happen, or always a possibility in general to happen, it is never the end of the world. Again, if they are able to continue growing, to continue to deliver for their consumers, again, I don't really see any problem with the stock having a little bit of a pullback off of good earnings there. And then moving on, I want to touch briefly on NIO and SoFi before we wrap up this video here. And again, NIO not having the best day ever here, down 1.36%, but there really wasn't any crazy news coming out of the Chinese electric vehicle market today. Again, just like we talked about in prior videos here, we saw that nice break to the upside. We pulled back to the daily 10 exponential moving average, and all we are doing now is consolidating in this big range of support that has been respected time and time again on NIO here. Now, we did see some interesting news here. Now, while I won't necessarily label this as significant here, because again, this could be a lot of ETFs, this could be all sorts of different things happening, but BlackRock did report a 65-ish percent ownership increase in NIO, on their NIO position there. So they own a position of about 3.4 million shares. It's only about $13 million there, which is why I'm saying it's not that significant. But again, showing that institutional ownership increase really is never a bad thing when you think about some of these names that the market isn't all that interested in at the current time. Now, just a little bit of an update here on that idea that I was outlining for you guys on SoFi over the last couple of days here. This post-earnings consolidation setup is starting to form in a very, very nice way here. Again, I know a lot of people were disappointed to see SoFi not absolutely continue rocketing up through this level that I outlined for you guys right around 14. But But again, what did we talk about going into SoFi's earnings? They were probably going to report some very solid numbers, come up to this 14 area here. We actually ended up getting through, and then a little bit of a pullback. So a little bit more volatility than we overall expected here. But if we can continue to see SoFi consolidate here or even break to the upside of this range, you could easily be back at that 14 area in no time. So guys, that is going to wrap up this video here. If you guys did enjoy the information and analysis that I provided for you guys in this video here, make sure you go down and hit that like button. It costs you nothing to do it, but it helps me out a whole lot in spreading this information out to as many people who actually want to learn. And again, if you never want to miss another video like this, make sure you guys are subscribed, turn on notifications so you're notified every time these videos get posted live. But until next time, guys, I will see you. Peace.